Hi, green industry business owners. It's Carla Policastro, co-founder and CEO of Cycle CPA, where we do anything from bookkeeping to CFO services, and we specialize within the green industry. And today I'm going to speak with you about lines of credit, the advantages and disadvantages, the types of lines of credit, and some of the forms that you would need to apply for a line of credit. So a line of credit could be advantageous within the green industry because of the seasonality of the work. Also, if you perform large install or design build jobs, you may need an influx of money up front for materials and labor costs before you receive the money from your clients. So a line of credit is advantageous within this industry in particular, but you have to know how to use it and also the terms. So lines of credit are flexible because you can take out money from a revolving line of credit as you need it. It's not like a traditional loan where, let's say you take out, you qualify for a $20,000 loan, and now you're paying interest on those $20,000. Whether you use the full amount of the $20,000 or not, you're still going to pay interest and have a fixed monthly recurring charge based on that. A line of credit is different because you can qualify for a credit line. Let's say you qualify for a $50,000 credit line, but you use it as you need it. So maybe you only need to use $5,000, and so you pay interest only on the $5,000, only on the amount that you're taking out. And it's also advantageous because a credit line, you can borrow on the money. So if you borrow the full $50,000 and you pay the full $50,000 back, it stays open, so you can again borrow on it and during the next season that you'll need it. And so with a traditional loan, it's not an open line of credit, right? As soon as you borrow the $50,000 and pay the $50,000 back, that's it. You can't keep borrowing from that same loan. You would have to apply for another loan. And so usually the interest on a line of credit is also lower than the interest on a traditional loan. And it's also different from a credit card because lines of credit have higher credit limits usually. Now, one of the negative aspects of a line of credit is that you may have to get a secured line of credit, which I'll get into what that means. And also sometimes borrowers tend to overspend because they have that flexibility in withdrawing having access to cash, and overspending is definitely a concern. So using the line of credit in a responsible and manageable way is really how you're going to leverage that within a seasonal business or larger projects. So the types of lines of credit is short-term and long-term lines of credit. The short-term line of credit has a higher interest rates and lower limits and lower revenue requirements. The long-term or medium-term lines of credit have higher interest rates and higher borrowing limits, and so those are the differences between those and unsecured. So there's also two different lines of credits that you can take out. So it could be unsecured and secured. So the unsecured line of credit, that means that you don't have any collateral, which is nice because your assets are freed up in case you want to make another investment or have, if you have any other items going on within that. And a secured line of credit, that means it's backed by something. Now, a secured line of credit, like I mentioned before, is backed by some sort of collateral. So There is usually funding available up to 25 million with these types of lines of credits. And one that is very prevalent within the green industry and construction industry is equipment-backed lines of credit. So equipment-backed lines of credits could go up to 25 million in funding. These are best used to finance the purchases of a fleet if you want to purchase a fleet up front, or if you're purchasing materials for a large construction job up front. And equipment-backed line of credits have repayment terms up to the useful life of the equipment you're using it to back that deal. There's also invoice-backed lines of credits, and it's similar to invoice factoring. So, but the difference is that the business owners don't sell their invoices to the bank. The line of credits could reach up to 10 million. There are no repayment terms with this line of credit because when the lender collects on the invoices, then those invoice amounts get applied toward the balance of your line of credit. And that could be two alternatives if you don't meet some of the other requirements. Secured lines of credit are easier to qualify for. Now moving into requirements and qualifications, you will need, depending on the line of credit, you'll need to have a certain amount of months or years in business. And also you'll need to have your tax returns for the past year or few years prepared. And you'll definitely need a profit and loss and balance sheet statement. So, that's where we would come into play. We issue financial statements every month. And so when you're looking to qualify for these types of loans, having readily available books is really advantageous, especially, counting the seasonality of things, during the time where you may need a line of credit the most during the slow season and so on. That's when you'll want to have your books readily available and prepared, so that way you can present the profit and loss, balance sheet, forecast, or budget to your financial institution. All right, well, I hope you guys had some value out of this video. If you guys have any questions, feel free to email me at carlap@cyclecpa.com. Have a nice rest of your day.